Hi, Len Haydenchuk here with our financial lens, the state of the economy. We're going to take a few minutes to look at where we are today, how we got here, particularly last year, and where we think we're going to be maybe 10 years down the road. From there, we're really going to try and focus on what the next 12 months might look like, because that really is what most people are interested in. So if you look at the last 12 months, we have been in a crazy market cycle, a big down, a big up, and it was really following 11 years of unprecedented bull run. The last 12 months has had a big decline where the GDP fell by 31%, it rebounded by 33%, and then it grew by 4% in the fourth quarter. Historically, the GDP has grown by 2.8%, and it's a little hard to know where we are going to be this year, but we do know that the economy has been in quite a turmoil. If we look at the unemployment figures, the unemployment figure for the U3 unemployment figure was way up, and it's down to about 6.2%, which is about the average long-term unemployment level, but quite a bit higher than the level that it was prior to the pandemic. Let's take a look at price-earnings ratios. The price-earnings ratio currently is at 22.2, which is at a high level. Typically, it's at a much lower rate, at 15.4, but it's at a higher level right now. But as we see, we have different PE ratios for different markets around the world. The US PE ratio is 22.2, developed nations is 17.3, and emerging markets is 15.8. So not all markets run the same way. Now that we have a little idea where we are, let's take a look at how we got here, what happened to get us to the current market valuations and the prices that we see in the stock market at this time. First of all, we should talk about the government intervention. We have had unprecedented stimulus. Phase 1, 2, 3, 4, 5, and Phase 6 in 2020, a total of $3.7 trillion were pumped into the market and through government intervention that helped stimulate the economy. If not for the government intervention, we would have a horrific stock market situation. It's also interesting to note that a single party controlled government has higher returns than a mixed party government. As we know, the White House, the Senate, and the Congress are all controlled by the Democrats. And if we look at a unified government historically, the first congressional session of a president's term grew by 15.4% compared to a 5.6% return when we had a gridlock. We also wanted to look at stock earnings and valuations. And what's interesting to note is the PE ratio is 19.7 for all remaining stocks other than the top 10. The top 10 have a price earnings ratio of 33.3. So those top 10 bring the average up from 19.7 to 22.3. We had a V-shaped recovery in the economy, and earnings has markets pricing them better in days ahead. The stocks appear to be priced at a high level, but it's a little bit hard to know because it's hard to really know what the earnings should be with this moving target of employment and consumer spending. Let's take a look at one specific stock that had a particularly interesting story. If we look at Tesla, Tesla is one of many car companies in the car manufacturing segment. And if we look at the 9 top companies, Fiat, Chrysler, Honda, Ford, SIC Motor, Hyundai, Kia, General Motors, Renault, Nissan, Volkswagen, and Toyota, they have a much larger share of the market than Tesla. Yet, the Tesla market capitalization, what their stock is worth, is as much as all those companies combined. How could that be? That's extraordinary. Well, it's based on anticipated future profitability. So that's an example of how sometimes the price earnings ratios just get way out of line with what we may expect and how that might affect market valuations. Let's take a look at the stock market 10-year rolling returns chart, specifically looking how the value of $100 invested in the S&P 500 would be worth 10 years later. Right now we're at a high level, meaning that the stock market has increased in the last 10 years, and particularly recently, to have gotten a better return over this last period of time. What that means is that we might expect potentially low returns in the future, which we'll take a look at. However, we also should talk about the very low interest rate of a 10-year treasury of being about 1.5% and a 2-year treasury at just about 0.15% gives the investor very little opportunity to get any returns in fixed instruments. As a result, that forces more money into the markets and drives up demand, and as a result, the prices of stocks. So looking at the past and where we are right now, let's take a look at where we might expect valuations and returns of different investments to be in the next 10 years. According to Vanguard, the US equities might return someplace around 3 to 5% in the next 10 years. The global equities, excluding the United States, might get between about 6 and 8%. US aggregate bonds might get between 0.8 and 1.8%, which is just a little bit more than global non-US bonds, which would get between 0.6 and 1.6%. And right in that same range is where we see cash positions. US cash will get someplace between 0.7 and 1.7% return. So as we see, there's very little returns in the fixed instruments, and the opportunity for investors, quite frankly, is to figure out which equity positions or equity opportunities segments will get a better return and how to squeeze some better returns out of the fixed investment opportunities. Let's take a look again at the price earnings ratios of the stock market. As you see, they're very high, and you might make an argument, given everything that's going on in our economy, that they're just about at the highest, best case scenario they can be. Of course, there's always additional upside, but it's priced out pretty much at the maximum. It's also important to note that we do have a very high volatility. The volatility is higher than the VIX average of 18.1%, right now being at a rate of about 24.7%. Let's take a look again at the price earnings ratio. As we see, the price earnings are very, very high. The question is, what lies ahead? How's the market going to look in the next 12 months? And we also need to keep in mind that market volatility is high. Everything is driven by the pandemic. The pandemic caused the markets and the economy to take a hit, and the recoveries will help it to get back to normal. The question is, how long will that take? And the market is figuring that things will be back to normal by the end of the year. We'll be approaching full productivity in the third and by the fourth quarter. And if that happens, the market valuations will be fine because the price earnings ratio, which is high, will be reduced to normal levels when the earnings go up and the prices only go up modestly or maybe not at all. So it's all pandemic driven. The other question is, how will the government help? Will the government continue the spending which has been necessary? Will the government continue to support the economy? Will it support the unemployed folks who haven't been able to spend and keep the economy going with bolstering people's spending while they're out of work? That remains to be seen. So there are really a few things that can happen with the market. One, the market can continue to go up, but that would not be justified by the economy. The economy ultimately drives everything. So unless the economy really grows significantly, when the things return back to pre-pandemic days, if it continues to grow from that point significantly, we'll see continued growth in the market. However, that is somewhat unlikely. The other unlikely scenario is to see a big market crash. We could see that, but the government has made it clear that they're going to support the markets so that if a market crashes, government will take actions to prevent that from being more severe. The most likely scenario is that the economy will just continue to grow steadily. The markets were going to be somewhat stable. They might go up a little bit, they may go down a little bit, but we don't expect to see significant market valuation changes because it will not be justified by the economy. The government is already doing all it can to keep things going. The other question is what is going to happen with taxes? Taxes really affect the individual investor and is what is left after income is earned and government takes their piece. It's a little bit hard to tell, but it does not seem like there will be government action in a significant way in any time soon. So thank you for joining us for our economy report. This is the Financial Lens, the state of the economy. Thanks for joining us.